Geopolitics of Economics, Global Economy, Big Picture on World News Explained.
Welcome to the Buzz and Rave Show podcast of the world economy and the politics around it.
How are you doing, folks? How the world shaped to be in the form it's in, and what factors ties to it that we all eventually face? We'll try to encapsulate it all.
Absolutely. The regular guy tonic. Don't just drink what's given to you.
And don't just digest that made crispy for you.
Let's see the economics, the market, and the money in news.
In U.S. Fed's, Chair Powell is going to address AKA signals what's likely going to happen to interest rates.
Essentially addressing reassessment of the effectiveness and transmission of monetary policy.
And the most interested party is no other than our central banks. U.S. has kept the interest rates higher for quite some time. What do you make of it?
U.S. economy could afford to keep them higher, and as you can see, it sustained it. Various price indices and inflation gauges didn't really go out of control, did they?
Not really after massive cash spread in the economy during pandemic. Economy seems deflated to some extent.
No other major economy could hold that for that long. To the point of business as usual, interest rates, elsewhere, Flash Purchasing Manager Index, or PMI as they call it, are in focus, and they already have cut interest rates earlier this year, namely Europe, Japan, and Canada.
While China to keep loan prime rates steady, which tells us what?
China's interest rates are much lower than US's, which is putting downward pressure on the country's currency, and as yields are falling lower. The invested capital, which was in fixed income market assets, such as bonds, begun to suffer.
Well, that's always a risk for being in risk-free assets. But Europe stocks close higher the past week. That's a positive news for Europe in short term at least.
Right. Long-term growth outlook does some negative, as persistently high unemployment erodes skills, discouraging labour market participation and undermining the EU's long-term growth potential. Low overall growth is making it much tougher for the hard-hit economies in southern Europe to recover competitiveness and regain control of their public finances.
And this risk is concentrated in one country, that's Germany, according to the Economist, not us.
And South China. Morning Post talks about Chinese copper supply chains being non-competitive. Is it costly for China or the US?
I think they are talking about the risks for the other side being costly for certain reasons. A global supply chain shift away from China's copper manufacturing industry would take massive investments. Over the past 5 years, the U.S. and allies have pushed for de-risking and decoupling from Chinese supply chains across industries due to political concerns.
And rhetorical response to that is China's own cross-border interbank system, which can reduce risks to its financial security as the drawbacks of a US-centered global monetary system have become too prominent to ignore.
Among other news, AI mergers have begun. So as the commentary on how AI phones from Google and Apple will erode trust in everything.
And Taiwan cuts 2024 GDP growth forecast despite rising AI demand. What does this tells?
It tells that the bogus inflated AI boom doesn't translate into countries' GDP. For simple reasons. Countries, manufacturers, and consumer businesses are either investing or thinking about investing. No one is remotely even seeing returns on their balance sheets.
Sounds like a bubble ready to pop.
This AI boom has definitely created wealth, especially in Western Hemisphere, which can then be used to various endeavors to fund.
That's brilliant. Attracting everyone's money, then use it to fund endeavors. It's not like money has disappeared, it just hasn't yielded anything now.
So from a bird-eye view, I see global politics is pivoting global economics, not the other way around.
And I see the politics around it to magnify in near future. And with that, we conclude this podcast. Do like and subscribe.
Thanks for watching. Catch you later.